Yes, sir. Good morning.
All right, good morning. So, apologies that we are starting a little bit behind schedule. So we are continuing from where we stopped last time. Okay, we started the new chapter, audit evidence, and we have looked at some aspect of it. So we stopped at directional testing the last time. Okay, so we are taking it further now. We are looking at analytical procedures, or we call it analytical review procedures. Okay, still on chapter 8, audit evidence. Now, when you talk about analytical review procedure, what does it mean? What does it entail? Now, remember, we have come across this terminology at the earlier part of this chapter when we're looking at methods of obtaining audit evidence, right? Where I defined analytical review procedures as an audit procedure that allows for evaluation of financial information, okay, through the analysis of possible relationship between financial and non-financial data, where I made mention of the fact that we have types of analytical procedures. Example, we have a ratio analysis, we have a trend analysis. I think we also have a net changes, okay? Net changes is looking at variation in two comparative. So you have, when you prepare financial statement these days, you have comparative and the year under review. So when you look at the comparative, that is the previous year, and look at whether there's an increase or there's a decrease in the year under review, that will account for whether an addition or a reduction. Okay, so so when you decide to calculate all those additions or increments or decrease in that financial statement, what you are doing invariably is what we know as what net changes. Okay, so now, analytical review procedures is an additional form of audit evidence, because when you perform analytical review procedures, what you are doing is that you are trying to get more evidence, okay? You are trying to validate, you are trying to verify, you are trying to get reasonable level of assurance, okay, that the audit evidence that you have obtained initially is actually correct or is sufficient and appropriate, okay? So that is what you need to know about analytical review procedures. Now, I also need to let you know that analytical procedures can be used in so many areas, okay? You can use it when you talk about budget and forecast. Okay, that's when you use the trend analysis. Okay, you look at what did you budget for, what have you actually achieved. Okay, so you use it for forecast. Okay, you can also use it for when you talk about predictive estimates. Okay, so for instance, you want to determine the pattern of spend of a particular expenditure. For instance, maybe under admin expenses, you have foreign expenses, and you know that maybe last year or last month, what you incur as fuel expenses for vehicles was X amount of money, and you are comparing with this month. This month now, you are seeing that you have spent above and beyond what you actually spent last month. That could be a pointer that maybe there's something that is missing. There could be that maybe there are some transactions that have been erroneously posted into that account that have spiked the value or the account balances or the transactions value in that particular account. It could happen at times, okay, when you post into the wrong account, it could happen. So all of these are what analytical review procedures can be used for. All right. Analytical procedures can be said to be uh, a form of can be used as form of what test of detailed transaction, because like I said, you're using it to validate the audit evidence that you had earlier obtained or gathered. So you are using it to validate it. So it tends more towards a test of detailed transaction. Okay. What you need to know also with analytical procedures is that you can use it at three stages. Okay, you can be used at three different stages. You can use that at the preliminary stage. For instance, like I said it when we look at chapter 3, I mean chapter 5, where I said that before you tender, before you submit your tender, you have to do what we call a preliminary risk assessment. Remember, I said that. So you can use analytical review procedures in that area as well to look. That will give you pointers, okay, or key performance indicators, areas you are going to focus your attention on. By the time you look at the ratio analysis, you're able to say, oh, this thing, why is this thing not trending? Why is this thing not jiving? That will give you insight as to knowing what you need to do. You're able to get sufficient and appropriate audit evidence, okay? It can be very, very useful in that area. You can also use it, like I said, substantive analytical procedures. That's what I said that. You remember I made mention when we started this audit evidence, I said that there are three tests that can be performed in order to obtain audit evidence. The first one is test of control. The second one is test of data transaction. And I said the third one is what? Substantive procedure. Where I said that substantive procedure is a mix of test of data transaction plus analytical review procedures. Okay, that was what. Remember, I said something like that. So you can use it also while the audit is going on. Okay, so that you're able to ensure that whatever evidence that has been obtained, okay, is has been given the necessary uh, assurance, reasonable level of assurance that everything is fine. All right. Then at the last stage, you are going to use analytical review procedures is the final analytical review. Okay. Now, final analytical review is after you have done the audit, you have completed the audit, right? Then we need for you to look at all the audit documentation, particularly the audit checklist, to see that all the areas that you're supposed to touch has been what has been covered. Because it will not be nice when you have planned for an audit, at the end of the day, there are some areas that you did not touch. So the whole essence of this is that by the time you are done with the audit, you have to pick your audit plan and your audit checklist and see that all those areas that ought to have been checked, ought to have been examined, ought to have been audited has been what has been done. Okay. And in the course of doing that, if some of them are not giving you the expected output, or you are going to perform some tests. So when you perform those tests and the test did not give you the expected value or the expected output, you might need to perform additional audit procedure, okay, for you to substantiate that, oh, this is what is wrong with this thing. Why did I say so? At the end of the day, when you are done with your audit, your findings, you present it to the management, right? Upon presentation to management will, in some instances, they will argue it out with you, say that no, this is not the position. That is not true. There are instances like that. So when you have such instances, what you need to do is only for you to argue with them. What you need to do, take their own point of view and perform additional audit procedure. And that will come under this last one, final analytical review. I hope you understand. So these are the instances or areas where you can utilize analytical review procedures. Okay? I hope we are together. Are we together? Are we together, class?
Yes, we are, sir.
All
Yeah,
right.
go ahead,
But
So
sir.
I'm not sure. I can't see your screen. No, I don't know if you are sharing anything on your screen.
I've shared
Yes.
it. Can you see can others see my screen?
No, sir.
Okay, let me reshare. Don't worry. Sorry. Thanks for the observation.
Yes.
Can you see my screen now?
Okay. Yes. Yes. Now we can see.
All right. Thank you. This is what I just discussed. The three stages in analytical review procedures. Preliminary analytical review, which I just explained. Substantive analytical review. I also just explained that. Okay. And the last one there is the final analytical review, which was what I just completed. All right. So we move ahead. So we move to the next area. I told us that this is one of the voluminous aspects of the ICAN syllabus, even to date, okay, even with the revised syllabus, it's still one of the most voluminous aspects of it. So we are moving to the next area, which is the audit documentation, or we call it audit working papers, okay? Then you call it audit documentation, or you call it audit working papers. Anyone you use, nobody's going to penalize you, okay? Now, and the relevant standard for this particular section is ISA 230. Exercise 230 explains audit documentation. Okay. So what do we mean by audit documentation? Now, audit documentation can be defined as all the information obtained, okay, by the auditor in the course of the audit that will uh, that will be utilized, okay, in arriving at his audit opinion. So as you are as an auditor, external auditor, when you are doing your audit, you are to obtain audit working papers, okay, all those records, all those information that you gather, right? That forms your audit documentation. All right. Now, this is very, very crucial in any audit. Okay. Without audit documentation, there is no evidence to show that the audit has been completed. So it's a very vital aspect of the audit engagement, audit documentation. All right. Now, the audit documentation provides a record of the audit procedures that has been performed. Okay, all the audit procedures that have been performed. Did you use observation? Did you use external confirmation? Did you recalculate? Did you carry out the performance? All of these things are the audit procedures that will be what? That will be performed. It will be contained in the audit documentation. The audit evidence obtained, the audit evidence obtained is also there. So we know we talk about audit evidence, all the sufficient and appropriate evidence that you have gathered will still form part of your audit working paper. Now, as at the time the name audit working paper was carved out, right? Audit was mainly in form of what? Was mainly manual. They make use of paper, okay? They make use of paper, large volume of paper, and they make use of a file, okay? To keep those papers, okay? Those documents, they keep them. Now, with the transformation from manual to computer-based now, electronic, they still retain that terminology, that is paper, audit working paper. All right. But mostly now, audit working papers are contained in computer generated or electronic generated documents now. Okay. So I need to state that, okay, so that you understand where we are coming from and where we are now. And also in all the documentation, all the tests that has been performed, because in gathering audit evidence, you are going to perform tests, test of controls, test of this transaction, substantive for these procedures, all of these tests, the results of these tests will be contained in the audit working paper. Okay. Then it also gives you from that test, okay, from the procedures that have been performed, the conclusions arrived at by the auditor. Okay, the conclusions arrived at by the auditor, how we arrive at that conclusion. Like I said, audit is scientific. Okay, audit is scientific. That is why after the audit has been done, remember we look at it in chapter 5. When the audit has been done, before the audit report is signed and dated, the engagement quality reviewer will come on board and take a look at everything that has been done so as to be sure that the audit firm is not exposed to any form of liability from the part of the client. All right. So all that those things is going to be looking at the test results, we look at the audit plan, we're looking at the audit procedures, we're looking at how the audit evidence have been obtained, and how we arrive at the conclusion. All of these are what is going to look. And from there, it will be able to say, okay, yes, I agree with you, or there are areas of disagreement where they are going to sit and get it what resolved. Okay. So those are the documentation, like I said, provides a record, okay, for the audit procedure performed, the audit evidence obtained, and the conclusions that are reached at the end of the day. All right. Now, the auditor that is in charge, that is the auditor, the engagement partner, auditor is in charge of that engagement, must ensure that every significant discussion is documented. Every significant discussion is documented. That is why auditor does not rely on oral information. Remember, we looked at that earlier. They rely solely on what is documented. All right. And also, if there are any areas of inconsistencies, okay, then the auditor will also need to sit with the engagement control reviewer, okay, So we look at the engagement quality reviewer, sorry, engagement quality reviewer, and look at those areas and try to get it resolved. And how they arrive at the conclusion, how they're able to resolve those issues will also be documented and be shared and filed appropriately. All right. So that is one thing we need to know also. Now, there are reasons why we prepare audit documentation. Number one, like I said, without audit documentation, there is no evidence that the audit has been performed. So it enhances the quality of the audit. Okay? It enhances the quality of the audit because it is that information, what is documented, that will provide, okay, that, oh, this thing, or that we establish that this thing was actually carried out. Then number two, it facilitates the effective review and evaluation of audit evidence obtained at conclusion. I just explained that now. All right? Before the audit report is finalized. Now, number three, assist the audit team to plan and perform the audit because it is from the audit documentation you'll be able to look at if all the areas that ought to have been touched, to have been audited, has been, all the things have been done. Okay, it's the audit documentation that will give you that information. Okay, it's also used in assisting supervisors in directing and supervising audit work. So with audit documentation, you can actually give direction, okay, or supervision to some of your audit staff or audit engagement staff that you, okay, go for this, you are the one that do this area, do this one, you go and do this one, you go and do that one. You spread the work accordingly, and every aspect that every staff, audit staff handled, okay, will be documented accordingly. All right. Then it also helps to show accountability for the work performed. It helps to show accountability for the work because you are not going to report what others have done only. You're going to report what you have done as an audit engagement staff. For instance, audit manager, what did you do? You put it there. Oh, audit supervisor, what did you do? You put it there. Audit training, what did you do? You put it there. Audit agent, how far have you gone? You put it there. The agreement partner, that is the one in charge of the audit, his own activities too, it will also be documented. Okay, so everybody is accountable for the various aspects that they handled during the audit. Okay, and it also serves as a reference point, okay, for future audits. Okay, so if a new staff joins the audit firm now, for him or her to be able to appreciate what an audit working paper is, you'll be able to present a copy of past audit documentation to the person for the person to have a look at it, okay, and have an understanding of what it entails when we talk about audit documentation. It can serve as a reference point for future audits, okay? And also, for somebody that has not performed, please mute your mic. Hello, mute your mic. Mr. Ahmed Abiodun, mute your mic, please. Now, someone is asking a question. What's the difference between audit plan and audit documentation? Now, I will answer you this way. Audit, audit, audit plan is embedded in audit documentation. Audit plan is embedded in audit documentation. That is part of audit documentation is your audit plan. Do you understand? I hope it's clear, Informa. So that is the answer to your question. All right. So also for someone that's going to carry out the um, engagement review, engagement review, okay, engagement quality review on the audit, right? Even though it might not have, normally the person will not be part of the engagement team in the first place, right? But by reviewing, by going through, evaluating the audit documentation that has been done, okay, he can have a better understanding on what has been done so far, what are the areas that they need to conduct further audit procedures so that they're able to ensure that the audit firm is not exposed in any way. So these are some of the reasons or significance or target as well, the importance of audit documentation. Okay, I hope that is clear. Any question? Any question? We are good, right? We are good to go. Okay, let's proceed. Let's look at, we are still on audit documentation. I need to also explain that there are two types of audit documentation. Okay, in audit documentation, we have two types. You have the permanent audit file, which you can call permanent file, and you have the current audit file. Okay, these are the two types of files you have in audit documentation. Please do not interchange them. Okay, permanent audit file or current audit file. Okay, please ensure you understand it. So let's look at it. Let's look at the first one, permanent audit file. Why is it called permanent audit file in the first place? It's so called because it is a file that records information that will be used for more than one audit. It's a file that contains information that will be relevant for more than one audit. Why? Because the information rarely change. Information does not change. That is why you use them. So what that means is that the information that are contained in the information that is contained in the parent audit file do not change, okay, because of their nature. And from what we are going to discuss now, you see that this information does not change. Number one, you have the legal constitution of the company. So, class, can anybody tell me what is meant by constitution of the company or this word here? You can see my screen. This was I highlighted. What does it mean? You can tell me what it means. You don't have time, please. Let's be fast. Who wants to try? Who wants to give it a try? Nobody? Can you hear me?
We can hear you, sir.
So what does that mean, sir? This place I highlighted. This place. What does it mean?
Okay, let me give it a try. Can you hear me, sir?
Keep quiet.
Hello, sir. Can you hear me?
Please go ahead, sir. I can hear you loud and clear.
The legal constitution of the company, I think, in my own opinion, it should be in their standard operating procedures with which all activities of the step-by-step procedure with which the company carry out all its activities, ranging from staff recruitment up to finance section. It
Okay,
basically
for your
means
own end, right?
I think
yes,
I've
for
seen
that.
it word before. I think it's an acronym for either materiality, some evidence, then I'm not so sure, but I've come
Okay,
across this word before.
thank you. Let me not waste our time.
Hello,
Yeah, that
hello,
was
sir. Is it
yes,
memorandum and article of association?
I'm asking the question. You're asking the question again.
You highlight that acronym.
I
You say you
highlighted
should.
it. I said, what does it mean? You now ask me, is it, you understand? Question for question.
No,
I want an
no. I'm
answer.
just. Well, sorry, sir. I Google it and it gave me
Just
memorandum and
Google it.
article of association.
You just cheated. You just cheated. You just got cheated now.
No, I need to come out now.
Okay, thank you for the attempt. So the meaning actually is memorandum of association and article of association. That's meaning of memorandum. Okay. So what does it mean? These two documents are the legal constitution of the company. Now, the memorandum of association is a document that talks about or contains information about the company and the outside world. That is memorandum of association. Okay. So it contains the relationship that will exist between the company and the outside world, other business environment. While the article of association is a document that contains information about the internal governance, okay, internal activities about the organization, why was the organization set up, who are the promoters, all of this information will be contained in the article of association. So these are what we call them the legal constitution of the company. I hope that is clear. So this does not change over time. All right. You only change your memorandum of organization, unless you are changing the object of the business. Okay, that's the only time it will change. Okay, another document that will not change are loan agreement. Okay, that has been executed. Now, loan agreements are documents that are obtained when a client obtains a loan or a credit from a bank. So that document is like a contractual agreement and is binding on the client until when the obligation is fully settled. Okay, so it's also not meant to change. All right, it's not meant to change because before the loan agreement was signed off, there will have been some discussions, there will have been some agreement, there will have been some concessions, okay, back and forth to arrive at what the loan agreement will be. So it's not expected to change over time, okay, particularly the executed ones, old ones, okay. Number three, document that is contained in permanent audit file is a summary of history, development, and ownership of the business. A summary of the history, development, and ownership of the business. This does not change unless there's something drastic that has happened. Okay? So if you look at First Bank now, First Bank is the oldest bank in Nigeria. Right? The history cannot be changed. It's the oldest bank in Nigeria, followed by maybe Union Bank. Right? Now, development in the bank, you know how he grew from standard bank to becoming First Bank that we now have. You know, the bank was started in 1894. Okay, 1894 to date. 1894 to date is about how many years now? That's about 131 years that the bank has been in existence. Okay, so that history cannot be changed. All right. Then also the development that has happened in the bank also cannot be changed. You know, the bank now has transformed, has undergone several and serious transformation. As it is now, it is now not known as First Bank again. It now has a parent company known as First Holdco, First Holding Company. They now shorten it to First Holdco. All right. So the likes of Odudeko that used to be the chairman of First Bank has been what? Has been removed or replaced with Mr. Femi Otedola, that is now the chairman of First Holdco. Everybody is aware of this. It's not news any longer. Okay, so this information, they are there. All right, they are not expected to change. Then a record of the accounting system and procedures used by the client. That one too is not supposed to change because your accounting system, that is your ERP you are using, your accounting package you are using, your SOP, standard operating procedure you are using, they are not expected to change over time. All right. If there's going to be any change, will be maybe you are modifying it to improve your process, but it's not to change entirely. Okay. So that information is also considered to be some of the documents that will be contained in the permanent audit file. Okay. Then copies of previous audited financial statements in previous years. Those ones cannot be changed. Once that have been published, cannot be changed. Okay. So all of these are what constitutes the permanent audit file. I hope that is clear. Any question on that? Can we move on? Can we proceed? We go to the second, thank you. We go to the second type of audit working paper, which we call the current audit file, or we call it current file. Okay, now this one is different from the permanent audit paper, the permanent audit file. The reason is that this contains information that are relevant to the current year's audit, the audit that you are doing currently. All the information that you need are contained in that particular file. So some of the information that you have in that file include the final financial statement and the audit report. That is the audit report for the year under review and the financial statement under review will be contained in the current audit file. Okay. If there is any audit adjustment, okay, will also be contained in that file. All right. Audit planning memorandum for that year under review will also be contained there. all right? Then audit control material. What do you mean by audit control materials? Now, every organization, when you talk of audit firm now, every organization have some form of documentation that are peculiar to them. For instance, if you go to First Bank now, they have their deposit slip. And on the deposit slip, you see it there, First Bank. You go to Zenith Bank, you have the deposit slip. It's called what? Zenith Bank deposit slip. You see it there. Now, if you go to some other organizations, you see them having invoices, but you see their name on it. These are controlled documents. Okay? Now, let's bring it down to audit firm. So audit firm also, they have these documents also that they use to distinguish themselves amongst other audit firms. We call those documents audit control material. Example, time budget. Time budget here means it's a document that tells the audit engagement team how many hours they are to dissipate in a particular audit engagement. So you want to go and do an audit now. The time budget will specify how many hours you are going to use for the entire engagement, breaking it down into different segments and how many hours that have been allotted. Call it the time budget. Okay, review point also. So at the end of the audit, right, you have to look at what you have done, compare with the audit plan. Audit plan also is also peculiar to audit firm. Every audit firm has their own audit plan, and they write their audit firm on it. So it's a control document, all right? Then even their letter of engagement also, you see boldly on the paper. You see, they will tell you that this document is exclusive to KPMG, exclusive to PwC, exclusive to S&P, exclusive to Deloitte. You always see it there. Okay, that means that no other person that is not a staff of that audit firm should lay hands on that document. That was what it means, unless there is an express permission. Okay, unless there is what? An express permission. We call it audit control material. All right, it's a control document. All right. Then the audit plan also. The audit plan is what they are doing currently on the audit. It will be contained in the current audit file. Now, all the audit tests and procedures that have been performed will also be contained in the current audit file, and their result as well will be contained in the current audit file, as well as the schedules, okay? All those sales schedule, revenue schedule, purchase schedule, expense schedules, all of those schedules will be contained in the current audit file, all right? So that is the difference between the two of them. I hope we can distinguish them now. So there's the time that they ask this particular question. What are the difference between the parent audit file and the current audit file? What are the documents that are contained in both files? There's a time that they ask this question. Okay, so I hope if we are in that position, let's say such question comes out in this exam now, this diet, you'll be in a better position to achieve or to pass this one. Okay. Now,
audit adjustment.
Yeah.
So this audit adjustment, like,
yes,
does it relate to? How does it relate to this current file? What is the audit adjustment? And
okay, thank you very much. Let me explain it. So, ideally, right, the client prepares financial statement and the trial balance, everything, and send it to the external auditor to review. Now, that financial statement that has been prepared by the client and sent to the external auditor to review is what will bring him or her to the audit firm or to the client office to come and do what? To come and do the audit proper. Now, when it comes to the client office, we will be having discussions. How did you treat this your revenue? The client will explain. The auditor will not say that according to IFRS 15, what you consider as revenue is not yet qualified to be taken as revenue. So we have to adjust the revenue balances in your financial statement, and that will call for audit adjustment journal to be raised. The same thing can also be applicable to purchases or cost of sales. Oh, why did you have this one there? No, this one's supposed not to be there. It's supposed to be in this other one. It's supposed to be somewhere else. All of these are what will necessitate the audit adjustment. I hope it's clear, sir.
Thank you, sir.
All right, sir. So that is just that. So let's move on. So the features, we have looked at the importance of audit working papers, right? We have looked at types of audit working paper. Now let's look at the features. What are those characteristics that audit working papers should have? Number one, it must have the name of the client. The name of the client must be contained in the audit documentation. That is, this ABC Limited audit working paper. Okay? The accounting date, that is the reporting date that is under review. ABC Limited accounting period, January accounting period as at or for the year ended 31st December 2024 or as at 31st December 2024 will be stated there so that you know the year that is under review. Okay, a file reference. So every audit documentation has a unique file reference for easy traceability even after the audit has been completed. It has a unique file reference. So when you want to call up any information on that audit documentation, it will be easy because that file reference is unique to that particular engagement, okay? Then another feature of the audit working paper is the name of the person that prepared the audit working paper. Somebody must have prepared it, okay? And the date the paper was prepared must also be stated, all right? Then after preparation, another person will review it to be sure that all the information that is there is accurate. So the person's name will also be included in the audit working paper, and the date of the review will also be there. All right. They also have a key to explanations of the audit ticks and symbols. What do we mean by audit ticks and symbols? Now, I will put it this way. So you have put it in your own audit checklist that you are to recompute depreciation, asset depreciation in your client business, right? How do you do it? So you ask your client, what is the method that you have used for this depreciation? The client will tell the auditor, we use sum of digits method. The auditor will also compute it using sum of digits method. If they arrive at the same value, it's a tick that is, oh, we are in agreement in this one. They will tick it as what? Good. That's what we call audit ticks. But peradventure, you did your computation of depreciation, and what you arrived at is different from what the client has done. For instance, maybe you are looking at property, plant, and equipment, and you saw that what you have there is different from what you got. And you now asking, what happened? Why is your own value or depreciation different from my own as the external auditor? Right? You will now say that, oh, this is the reason. We bought an asset in the middle of the we bought a new asset. When did you buy the asset? Middle of the month. But the computation you have done now, you have used a full month depreciation. That is the reason why your depreciation value was different from my own. Okay, because you said that what's the condition for assets? IAS 16, property plant and equipment says that all the costs incidental to putting the asset to use must be factored. So that day that you started to use that asset, that is when you are going to start depreciating that asset. So you started in the middle of the month. You cannot use a full month for that. You are going to prorate it. And that is what has resulted in that the auditor will now mark it as a symbol that we need to resolve this one. But if all the auditor has checked aligns with what the client has done, is going to be a what? A tick that like good. Okay, good, 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 good. You understand what I'm saying? That's what we mean by audit ticks. Then, if there are any errors also, okay, if there are any errors or omission identified, right? Everything will be listed here because after the audit has been done, the essence of the audit documentation is to compute or to develop a report that will be shared with the management that this is the outcome of the audit that we have just completed or concluded or performed in your client's premises. Okay, that is what will be there. Then you now have another thing that that's also a feature of audit documentation is the auditor conclusion. There must be a conclusion in every audit. There's no audit that is left open-ended. There must be a conclusion. All right. So the auditor, like I said, is expected to ensure that all these audit working papers are compiled 60 days after the audit report is signed. 60 days. You can see it here. They can ask you in exam. They can say that some of these things, you just see them in passing. You might not pay close attention to it. You tell you that the auditor compiled the audit documentation 90 days prior or 90 days before. When you see something like that, it's to tell you that, oh, this is not supposed to be. It's supposed to be 60 days, not 90 days. So these are some of the areas you are going to. That's how you know this is what the question is testing. This is what is being tested in this question. Okay, so you need to have eye for detail. Like this one I just explained now, they can put it in a case study and tell you that the auditor, after completing the audit, he did not do that, he did not compile the audit working paper until after 120 days or after 1 year. That should not be. The standard is what? No more than 60 days after the audit report has been signed. Okay? And like I said, audit documentation should never be deleted. You cannot delete it. They will be kept forever. Okay? Because they are paper in that time, as at that time. Now, what you need to do is to upload them into the cloud now. They are being uploaded into the cloud server. Okay? So that they will be, because you can, at any time, the client can call for it. There's what we call back duty investigation, where the tax auditors or the relevant tax authorities will call for an investigation. And when they do back duty audit, it can go as far back as 6 years, 7 years. That is one of the reasons why you cannot destroy audit working paper. You have to keep archiving it. You have to keep storing it. You have to ensure that it is always readily available. All right, that's what that means. Okay, and like I said, we have moved from the era of using manual paper, to electronic format now for audit documentation. Okay, so you make use of we have audit software, which we have also looked at in chapter 7. Okay, so audit software has in place or inbuilt the audit documentation. Okay, there is audit documentation embedded in the audit software. So what that does is that it makes audit working paper to be neat, okay, easy to read, and in standard format. Remember those days when we were using typewriter before the advent of computer? Then, if you are using typewriter, you started with manual typewriter before you came to electronic typewriter. Use electronic typewriter, sometimes you still make use of that correction fluid. When there are errors in the process of typing, you use correction fluid. But the moment computer came, that is the day the use of correction fluid reduces drastically. Okay, it reduces drastically. So, and because you can easily delete what you don't like, what you have spelled wrongly, you can easily delete it on the computer. You don't need correction fluid to do that. All right. And sometimes before now, some of us have very good handwriting. Okay, to the lighter mode, right? So when your writing is not clear, it's not legible, it can lead to so many misunderstanding or misconception of what you're trying to say. Well, because everything is now in electronic format, right? It has nothing to do with your writing again, because you have the standardized format of writing. Okay, you can use Area Black, you can use font size 12, you can use whatever, provided it is what? It is legible. All right. Then also, there is lower risk of errors by the auditor, because now everything has artificial intelligence enabled audit software. The software that we are using now, right? Most of them, they are artificial intelligence enabled. So they are smarter. So the risks of errors are what? Are reduced. All right. Then it makes it easy for, before now, when you're looking at that paper, wherever the engagement partner is, he has to come to that client office to come and review it. He cannot do it remotely. But because now it has been transformed into electronic format, right? The engagement partner, who is the auditor, the external auditor, can be anywhere in the world and hold a session, okay, to reviewing the audit documentation without paying visit to the client's office. All right. Then the amount of time that is spent in documenting, in looking for paper, writing it, stapling it, filing it, all those times, the time resources has been what? Has been saved with the advent of the computer-generated audit working paper. All right. So that is that about that area. Any question? Any comment? Any observation?
So the 60 days
Contribution?
retention
Yes.
period, I want
Yes, sir.
to add, like, I need clarification. Is it that the 60 days after audit procedures have been concluded, the auditor is expected to retain those working paper for maximum of 60 days before he can do whatever I want to do with it? Abi, like, what's the 60 days?
See it here. The auditor to assemble the final audit file on a timely basis after the date of the audit report, ordinarily not more than 60 days. What that implies is that after the audit has been completed and the report is signed, then you have 60 days to ensure that everything that you use to arrive at the audit report is properly filed and what? Stored away. I hope that is clear, sir.
Okay, I get now.
All right, thank you very much. Any other question? Any other question? Comment? Observation? Contribution? We are good to go, right? Let's move on. The next one we need to look at is ownership, custody, and confidentiality of audit working paper. So what this one is asking is this: who owns the audit working papers? That's the question, really. Who owns the audit working paper? The audit working paper is exclusive to the audit firm. It belongs to the audit firm. Okay? It's not for the client, even though the audit firm is keeping that file on behalf of the client, but it is not the property of the client. It's a document that is kept and exclusively reserved for the audit firm. All right? Please note that it's not for the client. They can put a case study and ask that the client held on to the audit working paper and he said that it belongs to him or her. They might just put one line there. And if you are not very, very observant or to be able to read in between the line, you just gloss over it. You don't have anything to say. But now that you know that, oh, this document is not for the client, you know that this is an abnormality. It's supposed not to be. All right? So that is that aspect. That's what it talks about. Okay? They are the ones that keep the audit working paper. It belongs to them. All right? So we move to the next one. ISA 550. ISA 550 is related party and related party transactions. Related party and related party transactions. What do we mean by related party and related party transactions? Now, before now, right, in your CR, you have come across related party and related party transactions, right? And I think that's the standard for in CR is IS 24, if I'm not mistaken, right? That is related party transactions for in CR, right? It's similar to what you have here. But first of all, let's look at what do we mean by related party and related party transactions. Now, related parties are individuals, organizations that might have or might be expected to have an undue influence on the company that is being audited. Do you understand? A related party or related parties are individuals, organizations that might have or might be expected to have an undue influence on the company that is being audited. Okay? Examples: the directors of the company, families and friends of the directors, families and friends of the employee, okay, and have undue influence on the company that is being audited. All right? So the main essence here, please mute your mic. Mr. Ahmed Sherif Abiodun, please mute your mic. Ahmed Sherif Abiodun, please mute your mic.
I'm on it. Sorry, sir.
All right, thank you. So what you need to note here, I'm still going to explain more, but the essence of this standard is that in audit, it is believed that there is no, it's not a crime. It's commonplace for you to have related party, right? It's commonplace to have what? Related party. But what will be an abnormality, or what will be considered as a big issue, is where there is no disclosure, or where there is no sufficient disclosure or adequate disclosure as to those related party and related party transactions. That is where the issues will come. Auditors need to be able to see what are the related party transactions and who are the related parties in that client business that is being audited. But where the information is not disclosed or is hidden from the auditor, that could make the auditor to qualify the audit opinion. That could make the auditor to qualify his audit opinion. All right? So the auditor's role in this standard is that the client should have an understanding that the client should ensure that they have an understanding of what constitutes related party, okay, transactions and relationships. That is because the auditor is going to ask them who are the related parties and what are the related party transactions. You should be able to have an understanding of what is meant by related party and related party transactions. And they have to provide submitted and appropriate audit evidence about whether related party transactions or related party relationship exist and has been disclosed in the financial statement. Okay? Then they also need to ensure that they're able to recognize, the auditor is able to recognize fraud risk factors arising from related parties, because the truth is that one of the areas that are prone to fraud in organization are transactions that are related party concern or related party transactions. These are the transactions that are mostly susceptible to fraud, because an ordinary transaction that does not qualify as a related party transaction will not attract any suspicion. For instance, you're a manufacturing concern, right? As a client. Are you with me? So you are a manufacturing concern, right? You are into manufacturing, production of petroleum products, right? So let's say your tanker is like 3,000. You have a tanker like 3,000, right? And you are selling for, let's say, 850. So if on normal transaction, right, the customer will pay 28 million and 50,000. That's what the customer will pay. The value for like 3,000 liters of PMS at the rate of 850 will be 28,050,000. That's for normal transaction from from your factory. Let's say from Dangote. Now, because it's a related party transaction, that person is related to Dangote. That person has an affiliation with Dangote's wife or Dangote's children. So you bought 3,000, you're going to pay 850. The person now paid 750. So what you are going to collect from what the person will now pay is what? 24,750,000 naira. I hope you are getting the analogy. This will warrant questions at the end of the day. Why is it that this person paid less? It could be genuine. If it's properly disclosed, it could be a genuine transaction that is, yes, it's a type of related party transactions. But at the same time, it could be a fraudulent transaction. They'll just hide under the what? Related party transaction, and they will execute and cut away 24,750,000 naira. So that is the essence why the auditor is always very, very insistent on when it comes to related party transactions that it doesn't take it kindly with any client. Where they refuse to provide necessary information, the next auditor will do is to qualify the audit opinion. If he has been able to speak with the management, they did not do anything. He escalated the matter to the board of directors, he did not do anything. The next he's going to do is to qualify his audit opinion. And ultimately, if he sees that that will not suffice, he can resign from his appointment. That is after he has consulted with his legal counsel. All right. So the whole essence is to be sure that the information that is contained in the financial statement is what is fair. Okay, true and fair view. The financial statement shows what? A true and fair view. All right. So the auditor will not only be asking questions, the auditor will also perform some risk assessment, okay, as regards the related party transactions. It's going to take a sample of them and perform risk assessment. That is, what is the impact or what are the impact of these transactions on the financial statement that is being audited. So that will take us to the audit procedures for related party transactions. Audit procedures for related party transactions. What should the auditor do when he cites a related party transaction? What should he do? I said this and I'm going to say it again. Audit procedure question in exam, they are very, very tricky. And I always say, ensure you know them. Find a way to know them. You can use mnemonics like I did for when we talk about practice management, like I did when we talk about first in chapter 1. You can devise your own mnemonics. Because if you don't know it, don't even attempt it. But the essence is that the risks are high when you know it and you don't know how to present it. And you cannot just propose it, you cannot arrange them haphazardly. It has to be in a particular order, sequence. You know, I said that audit is prescriptive, so you have to be in that sequence, step by step. Once you jump any step in your statement, such students will be penalized. So you must ensure you understand the procedures step by step. For this one now, these are the procedures. Number 1, you need to consider the risk of material misstatement due to fraud or error arising from related party relationship and trust. That's what I just said. That's why I use the example of EMS. Bought it at 850. Some people bought it at 750. You can see the wide gap. 28,050,000, 24,750,000. You can see the gap. Number 2, inquiries into the identity, relationship, and nature of transaction with the related party. Just the example I gave now. Why is this person paying less than others? Others have paid 28,050,000. This one is paying 24,750,000. Why is that? Who are those? Who is the person? You have to dig down. You have to perform further audit procedure to establish and get to the root of it, who that customer is. Okay? The next thing you are going to do is to identify the accounting for an disclosure for related party relationship and transactions as it properly disclosed, okay, in the financial statement. You also need to look at the authorization and approval of significant related party transactions. Who approves these significant related party transactions? Because at some point, by the time you aggregate these related party transactions, it becomes what? Material. It becomes what? Material. Who gives the approval? Is it the same? Is it somebody that is related and still going to give approval, or is it another person that gives approval for the thing to what? to be passed in the financial statement. Who is the person? So you need to look at the authorization and approval of significant related party transaction. Okay, who gives approval? Is it Dangote himself that will say that, okay, let this person go with 24, let this person pay 24,750,000, or is it a neutral person that does not have any relationship that gives that approval? Because that could speak volume. Okay, then the authorization and approval of significant transaction outside the normal course of business. That's just what I just explained now. Normally, it's supposed to be 28,550,000. You are buying that 3,000 liters at 850 naira per liter. Well, in this instance, the person pays 750 and is paying for the 3,000 liters of PMS. Who gave the approval? All right. These are the audit procedures that will be performed. Okay. These are the audit procedures that will be what? That will be performed. Okay. Now, how will the auditor inquire about the related party? How will he know that there are related parties in that financial statement? The first thing we need to do is to have a discussion with the management and clients that before you even start, at the opening meeting, you ask, do you have related party or do you have related party transactions? They will agree on that in the first instance. Okay? And if they said yes, you will request for a list of related parties of the company. All right? Then, when that has been done, you will now review working papers for previous years to look for names of known related parties. So, from that list that has been provided, you will trace it back because if it's not that did the audit last year, he can lay his hands on the audit working paper for the previous year and look through those related party individuals or organizations. And if he's inheriting it from another audit firm, since there is coordination and relationship between the outgoing audit firm and the incoming audit firm, he can request for the previous year audit working paper from them, and he will look through. What he's trying to check is that there is consistency, not that they are giving him another list that was not included in the last one. All right. Then he will need to review the company procedure for identifying related parties. How do they treat their transactions? What are the guidelines? What are the modalities? Okay, who will give the approval? Exceptional approval. Okay, this transaction can fly because it's related party transactions. Then the auditor will also inquire about the relationship between the directors and other entities. That is the directors in this company, are they the same directors with other subsidiaries? Okay. Then we inquire, we review shareholders' record for names of major shareholders. So all those related parties list that was related to the auditor will go and check it with the shareholders, whether the people that constituted the related party are shareholders or majority shareholders of the company. Then you have to also review the minutes of shareholders meeting. Review of what shareholders meeting, because during their meeting, there will be some discussions, okay, that will trigger related party transactions, okay. So you need to get hold of the minutes of the shareholders meeting, okay. Another thing I can also do is to ask other audit firms involved in the audit about related party and ask questions, like I said, from the previous auditor, okay? So I can have a clear understanding of what related parties or what related party transactions, okay? So the auditor will be in a best position to be able to handle all of this area, okay? Another area that the auditor also need to look at, sometimes we need to look at any bank or legal confirmation obtained as part of the audit work. Sometimes you obtain some bank documentation, you need to review it, okay, to be sure that the bank does not have a stake in that business, like the case of Otto Anderson that time, okay, but there's no conflict of interest, okay. We need to review the minutes of shareholders and management meeting and any other records or document that the auditor considers necessary for specific circumstances, okay. I hope we are together. Any question? Comment?
No question.
Observation? Thank you very much. So another thing that you also need to look at is there are some indicators, okay, that will show that some individuals, organizations have what significant influence, okay? These are some of the things that we'll be looking out for. Number one, the party vetoing significant business decisions of the entity. So the business wants expansion. Who is the person that gives the power to proceed with the expansion? That person, whoever the person is, can make it easier for the auditor to know whether they are related whether they are related parties within the organization. All right. Then the significant transaction being referred to the party for final approval. So if all this expansion is only one person that approves it, that means the person has what significant influence on that organization. Okay. Another indicator, little or no debate among management in respect to business proposal made by the party. So if let's say the director, the executive director brings a contractor to the organization that will help them to facilitate whether building of another warehouse or so. And that director, upon presentation of that person's proposal, no other person could criticize or say anything or to review the document. Just say that, okay, everybody is just in support and say that these things are fine. It's okay for what? Implementation. That will also give you an insight that there is what we know as what? A related party person that exists in this organization. Okay? So we further to the audit procedure that we look at earlier. The one that we look at earlier speaks to the let me come back here. He speaks to how the auditor can understand the related party and related party transactions. Remember, before I came to this area, I already told you that the auditor will look at the effect of these related party transactions on the financial statement and eventually, ultimately, is going to qualify his audit report. You can see that that is not contained here. So this one is just the first stage of checking the related party transactions, okay? But after checking, right, these are the things the auditor will also need to guide against. So these are the things that will enable you to make informed decision at the end of whether to qualify the audit report or not, based on what he has been able to evaluate. So first of all, the auditor will first of all determine the underlying circumstances, confirming the existence of those relationship and transactions. That's the first one. Number two, he will communicate the relevant information to the audit team. That is, oh, this is what I observe. So and so person, they are related party to this organization. Three, request management to identify all transactions with the newly identified related party. All the people that they say they are related party, their transactions, they just pull it out, okay, so that they can see. And that the example I gave about Dangote refinery selling for one customer at 850 and another customer at 750 would be a good example in that instance, okay? Ask questions as to why the entity system failed to identify or disclose these related party relationship and transactions where it has not been properly disclosed. This will only be applicable where the related party transactions have not been properly disclosed. All right. The auditor will now perform substantive procedure on the newly identified related parties or significant related party transactions. Okay. Then it will also need to consider the risk of there being unidentified and undisclosed related party. You need to look at the quantum, the volume of transactions that this newly identified related party or related party transactions we have, okay, on the financial statement. So if the non-disclosure appears intentional, the auditor will evaluate the implication for the audit. That is where it's going to decide on whether to qualify his audit opinion or to or to seek advice from his lawyers and to quit. So for all of this, your take home is that yes, the auditor has been able to identify related party transactions, but he still needs to discuss it with the client. The implication of these transactions on the financial statement. And what he will expect from the client is is a support in the form of what? A letter. A letter will emanate from the client saying that, yes, all what you have observed, they are true. And we are fine by it. Oh, this is going to have an implication of no problem. We are fine by it. They have to commit themselves to that. And that is what the auditor will take as what? Audit evidence. So that process, that document the auditor will obtain from the client, justifying their position about those related party transactions, can also be looked at, okay, under the what? Written representation. Because they are going to have like a letter to support that, okay, so that in case in future, when there are issues, they will not say that the auditor did not report or the auditor's report did not capture these aspects. Because, like I said, the written representation will form part of the documentation that will be required at the end of the audit. Okay, so that is that about related party transactions. Okay, any question?
Sir, please.
Yes.
This paragraph that states if any fraud, that's after the
I'm
auditors
going there
identify
now. Continue. Go
if
ahead.
any fraud risk factor
Yes.
are found. This must be taken into account when auditors identify and assess the risk of material misstatement.
Where
Now,
are you,
I'm
sir? What page are
trying
you?
page 73.
Is that the place I highlighted?
Oh, no, sir. Up.
Oh,
You need
it's
to
still
go.
up. Okay, hold on.
Okay. Let me show.
Which side?
Okay. Let me find
I don't
my
want to be
fraud.
clear on what
Okay.
you are
This
saying.
is 550 bar. Keep going up like that. Just like that. Be scrolling. Is it up? Yes. Just continue scrolling. Yeah.
This one.
Continue scrolling. You're almost there. The next part,
Yes.
if that plays down,
Okay.
yes.
Okay, I'm with you.
If any fraud
Mm.
risk factor are found in this, must be taken into account when auditors identify. So I'm trying to understand the paragraph as relating to these related parties disclosure. Now,
Okay.
the place
Thank you.
of dominance is where it is getting me confused now.
The place of what?
This dominance influence.
Okay.
Mm.
Okay. Let me explain it. What they are saying is this. You understood related party transactions, right?
Yes.
Now, and I said that sometimes the related party, if it's not properly checked, will bring an avenue for what? For fraud, right? Now, why will it be an avenue for fraud? The reason is that we said that related parties are people that have what? Significant influence. So if somebody like a director, ED of an organization, right, decides to introduce a contractor to the organization that you're able to maybe to build something or to execute a task, and no other person checks, even the internal audit cannot check. Okay, internal audit cannot check, no other person can check, the CFO cannot check, no other person can check, only him gives the approval. Okay, what we are saying is that that kind of transaction will be taken or could be a suspicion of what? A fraudulent transaction. And that will generate the what we discussed in chapter 4, fraud and error, where we say that you have to look at the only procedure for fraud and error if it's what? If it's suspected. And that was why we said that if we go back to that standard, we said that the first thing we need to look at is the nature of the transaction, the effect of that transaction on the financial statement. Okay, you need to look at it whether it's going to affect the overall audit strategy or materiality of the audit. Okay, remember we said something like that. And also, we also said that you need to discuss with the management that you seek their what? You inform them in order to get what? To seek their buying, that whether they are aware or they are okay with that transaction, right? And if they are okay with that transaction, you need to ask them to give what? Justification. When they don't provide justification to you as an analyst, what will you do? You escalate to the board of directors. Okay, you officially communicate the board of directors, and you expect the board of directors to take it up and get it resolved. Now, if the board of directors can't get it resolved, you need to obtain a reason from them. Why are they confident? Why are they not willing to take this issue further? Right? Then that will now, if they still not do anything, you ask them for what? A written documentation that is supporting what their own stance on that particular transaction. Okay, so if they did not provide you with the written representation, what do you do next? You have to consider the effect it's going to have on your what? On your audit report. That means you might need to qualify the audit report, or eventually you might need to seek counsel from your from your lawyers on whether to even resign as the external of that client. So what this paragraph is saying, what this paragraph is saying is that as an auditor, you have to be able to you need to have an attitude of what professional skepticism when it comes to related party transactions. Because once you have the attitude of professional skepticism, that means you'll be able to probe further, to perform further the procedure, to establish that yes, this is a related party transaction, but it is not a fraud, it's not a fraudulent transaction, or this is a related party transaction and it can also be seen as a fraudulent transaction. I hope that is clear, sir.
Yes, sir. Yes, sir.
Is that clear, sir?
Yes, sir.
All right. Thank you. Any other question? We proceed. We look at still under audit evidence. We are looking at written representation. I've already talked about written representation. So, like I said, written representation is contained under ISA 580. Okay, and it's a written statement from the management to the auditor, provided to confirm certain matters or support other audit evidence. I've already said that before now. Okay, so this representation, like I said, is another form of what? Audit evidence. Okay, it's a form of what? Audit evidence. So as I was saying, this written representation forms part of the audit working papers, right? So it's going to be part of the audit working paper. So in case in future any litigation comes out, that's what the auditor will use to exonerate or to vindicate himself. All right. So let's look at the objective of audit written representation. Number one, to support other audit evidence. I've said that earlier, right? Number two, to fulfill auditor's responsibilities with regards to financial statement and the auditor and the audit. Okay, I've also explained that, right? Then written representations are likely to be needed to support auditors' understanding of management intention or judgment. For example, like the example I gave in the case of related party transactions or a fraudulent transaction, right? So from the explanation provided by the management or the board of directors, you can establish whether this information that they are provided suffices or not. All right. So that is the essence of the written representation. It's a document that is used by the client to support. Okay, they use it to support whether the auditor has said, or to make them to say that they are aware of those circumstances or those issues that the auditor is trying to bring on board. All right. But there are times when, like I said, the auditor might have its own perspective or perception about how certain transactions are done. You will need to discuss with them. So if after discussing with them, you could not agree, there's no issue. What he needs to do is to look at the impact of that aspect on the financial statement. At that point that they do not agree, how will it affect the financial statement that the auditor has just examined? Then, in some instances, the auditor might need to perform further audit procedure. Maybe there is an information that has not been provided to the auditor, and that will make him to come up with that particular point of view. All right. So that is what the auditor will need to do. Now, what you need to realize is that, like I said, the evaluation is usually prepared by the client. But technically speaking, right, this document is developed by the auditor. Auditor develops this document as well. Written representation is developed by the auditor. What does it do? Because he understands, Augusta, please mute your mic. So like I said, this document is also developed by the auditor. The reason is this: if they have to go back and forth, with all these issues, discussing one after the other, it's going to take time. So what the auditor does is that he has a template for all of this justification for management approval. So what will he do? What all this is communication. What he will do is that he will request for the client entitled paper and put that information on the client entitled paper and give it to them to review. So when they review it, there's some matter they are going to add, there's something they are going to remove, and at the end of the day, they are going to sign it. So the back and forth on that discussion, the time dissipated, the time spent would have been what? Would have been reduced. I hope you understand. Would have been what? Would have been reduced, because if not, they can spend 3 weeks fine-tuning what the final outcome of that letter would be. But because the editor has a template, they just need to adjust it to reflect the current position. And once that has been established, then it is good to go. All right. So list of areas where the management organization is needed. Number one, non-current assets. Especially, let's talk about impairment. Oh, they don't perform impairment tests on some assets. It will make the clients to provide written representation. Liabilities, contingent liabilities. We talked about contingent liabilities before. We make the client to present written representation. Receivables. There are some major receivables that need to have been what? To be written off. But management is saying that no, we still have some time. And you're able to put perspective to it. Okay. So all of these are some of the areas where written representation will be provided. Now, where the management refuses to give to provide written representation, the auditor will first of all discuss with them. After the discussion, you need to review, you need to examine or reevaluate the integrity of the management and look at the impact of this letter of representation is going to have on the audit evidence as well as financial evidence that has been examined. Okay? And at the end of the day, you will need to qualify his audit report. All right? So that is that about the written representation. Question, comment, observation. Question, comment, observation. Are we good to go?
So is there example of this written statement, written representation? Like, is there something
Written
that you can
representation.
do? Yes.
Yeah, okay, what I'll do, just what I'll look for a sample and maybe I share on the platform. All right? Are you with me, sir? I'll look for a
Okay.
sample and share on the platform.
Okay.
All right?
Thank you, sir.
All right, thank you. So move to the next one. Using the work of auditors experts. You know, I've been sounding like a broken record on this particular one, auditors experts. Okay, and why did I say so? I started it right from when we started. I started to talk about experts. Who is an expert? Now, auditor's expert is an individual or an organization that possesses skills, knowledge, and experience in other fields outside accounting and audit. Outside accounting and audit. Examples: lawyers, surveyors, architects, engineers, risk management consultants, IT consultants, actuarists. Okay? These are examples of what? Experts. All right? Now, what is the highlight of this area? The highlight of this particular standard is the relevant standard that explains this auditor's expert is ISA 620. Okay, what does it say? Now, this standard says that even though the auditor does not have knowledge in these areas, right? But he is expected to place reliance on the work of this expert in his audit engagement or during his audit engagement. Let me explain it. Now, the auditor is not trained as a quantity surveyor. For instance, the auditor is auditing a real estate company that are into building of houses. You know that at every point in time, you have, let's say at the end of the year, you might have some buildings that are being constructed that are just at foundation level. You have some that are on lintel level, that is just for them to roof it. You have some that have already been roofed, but still require plastering and electrical work to be done. And you have some that are already completed. So you can see various stages of completion of buildings. Now, no auditor in this world can quote me anywhere, can tell you the value of such buildings at these stages of completion. No auditor can do it. What the auditor will do is that the auditor will engage the services of what? An expert. The expert will now go and perform his own procedures. Okay, he will test all of those things and come up with certificates or reports that says that, oh, this building that is at lintel level, this is the value. The one that is at foundation, this is the value. The one that has been completed yet to be painted, that needs electrical, this is the value. The one that has been painted, this is the value. It is based on this. Then we now go back to the fixed asset of that, non-current asset of that company that's been audited and check those things, whether the values that they have put in the financial statement mirrors the values that the expert had just provided. Do you understand what I'm saying? So he's going to look at it, whether there is correlation. It might not be the same, it will be within a range. For instance, let's say for a building that is at lintel level at Lekki is about, let's say the range is about 70 to 100 million. A duplex, let's say 70 to 100 million. But when the auditor's expert came and evaluated, he saw that the building is about 130 million. You can say that's a far cry from what the range is in that area. So the auditor will need to ask the client, this rate, is it current? Is it updated rate of houses in this area? Or what is it? Okay, so those are the things the auditor will need to arrive at. But while discussing with the client, is going to assume the role that was the one that did the evaluation and not the expert. It takes full responsibility for the work of the expert. That is the risk in this standard. The risk of this standard is that the auditor, the external auditor, takes full responsibility for the work performed by this auditor's expert, except where the law provides that they can state that, oh, I make use of so and so expert. But in Nigeria, the auditor will take full responsibility for it. So in that instance I just gave now, the auditor will say that, let's say it's looking at it's relating with the client manager, you say that based on the evaluation that we did, it's what the value of you have undervalued these houses because the value we got is around 120 to 150. Can you justify your position? It's not going to say that, based on my expert that I use, so this was what he gave me. No, he's going to assume full responsibility. That is why auditors they have interest. They have information on every aspect, on all aspects. They have information on all aspects. So that's why they are versatile. You understand? That's why they are what they are versatile. But they are going to take ownership of that engagement. They will not even inform the clients that they are using experts. It's on their own accord. By themselves alone, they're going to say, for this one, we need the auditors expert to do it. The client might not even know. Okay? I hope you understand. So that's what we mean by auditors experts. Now, that is the essence that when you are going to appoint an auditors expert, you need to discuss it at the planning stage. Not that when the audit has started, though. As you are preparing your audit planning memorandum, you're also making decisions on whether you need an expert or not in that particular engagement. Okay? It's at the planning stage. Okay? Then the auditor, the experts also should be evaluated on cost benefits basis. How much is it going to charge? What are benefits are going to derive from this, from his service? But at the end of the day, you should be able to ensure that whatever information you obtained from the expert report or certificate is something that can what, like can rely on, like can place reliance on. Okay, so you should consider these factors, the nature, significance, and complexity of the matter. The auditor should do what? Consider the nature, significance, and complexity of the matter, especially if there are transactions or if there are events, okay, or if there are assets that are complex in nature. Okay, there's some assets that are what? That are complex in nature. For instance, we want to talk about building a refinery. There are some items, there are some transactions in that refinery project that will be what? Complex. So we need to look at who is going to bring on board to carry out a feasibility studies on this refinery project. Then what is the risk of material misstatement? Is the risk of that, is it high? That is the risk that the expert will commit material misstatement that will impact the financial statement. The auditor will need to look at it. These are the things that will warrant whether the auditor will need an expert or not. And if there are other alternative sources that the auditor can use in place of the expert, if there are, okay, if there are other alternative sources, okay, so those are the things that the auditor will need to consider when he's trying to appoint auditors expert. That's why auditor will not appoint their friend as auditors expert because of what? Familiarity. Because if anything should happen, the auditor will suffer for it because it takes full responsibility for the work of the expert. Okay, so when the auditor has finally engaged the expert, these are the performance indicators, okay, that you'll be able to use to assess the competence, okay, of the expert. Right? Number one, the auditor shall obtain an understanding of the expert field of expertise. So, like the example I gave about the building now, the best expert the auditor can use in that instance are either he uses a surveyor or he uses an architect. Those are people that will be able to give him, more importantly, surveyor. Those are people that will be able to give him or her the needed information. Okay? They will need to agree on the terms of engagement with the expert, including the scope, which area, to what extent, what does he want to achieve, the objective, and the expert report. And at the end of the day, the expert should also sign the non-disclosure agreement. He's not going to divulge any information from this, he obtained from this engagement with anybody. Okay? The auditor will also be able to evaluate the adequacy of the expert's work, including how relevant the expert work is to the audit engagement, whether in the course of his performance of his work, he was able to do a thorough job, that is completeness, and is able to provide accurate reports, okay, from the angle of the source data, source information, Okay, and the conclusions that he arrived at, that is, his conclusion should be what? Should be realistic. The expert's conclusion should be what? Should be realistic. All right? And that's what I said here. The editors has sole responsibility for the opinion issued and is not to reduce in any way by its use of experts. You can see what I just said now. I've said it already. During the border, I've said it here. This particular one. The editor takes full responsibility for the work of the expert. That's what they are trying to say there. All right? So, the auditor also, the competence, capability, and objectivity of the expert may be assessed. So, for instance, you want to use a lawyer now. These are the things you are going to use, whether you are going to use this lawyer or not. Personal experience with previous work of that expert. If it's someone that you have been using before now, and you can trust his job, you can trust his expertise. That is one. You need to also be able to have discussions with the expert. You need to have heart-to-heart discussion and see that that person understands the angle, your point of view of a discussion. Right? You need to discuss with other auditors or others who are familiar with the experts one. So you need to seek reference. Okay, references from other people that have used that person. Oh, this person, lawyer there and how far is his work? Is he a good lawyer? All of that, you need to do your findings. Okay. You also need to be sure that that person is not a fake lawyer. So there was a case sometimes last year or 2 years ago where they had a fake lawyer that had been practicing for over 10 years and he has won cases as a fake lawyer. It was in the social media then. A fake lawyer that has been practicing for over 10 years and has won cases in the court, and he was not a lawyer, but he was later apprehended or discovered. So for you to say somebody is a lawyer, the person must have gone to university and gone to law school and has been called to bar and is also a member of the Nigerian Bar Association. Okay? Sometimes they also you need to look at whether the expert has published books. For instance, you have in the law now, we have this Nigerian Weekly Law Report. Okay? Nigerian Weekly Law Report that is being published by Gani Fawoyimi Chambers. Okay? So that report shows a summary of all the decided cases that happened within Nigeria on a weekly basis. Okay, so whether you are in Lagos or in Kano or anywhere, this report contains decided cases across the 36 states of the Federation, including Abuja, on a weekly basis or monthly basis. All right, so you need to look at all of those things. These are the things you can use to know if the person is an authority in his field of professional endeavor. All right. So that's that about using the work of an expert. Any question, comment, observation? Contribution? Are we good to go? Okay, let's proceed. Go to the next one. ISA 610. The external auditor's reliance on the work of the internal auditor. Okay. This is also another area that we need to also review as well. Now, what we know is that in an ideal setting, right, the internal auditors and the external auditors, they work together to perform an effective audit. Okay, the external auditor will require the services and support of the internal auditors to perform an effective audit. Okay, because the internal auditors, they are more experienced, right? So sometimes they can give guidance to the internal auditors on how or those areas that they are trying to obtain sufficient and appropriate audit evidence. All right. But before the external auditors can place reliance on the work of the internal auditors, the external auditors will need to carry out these evaluations. Number one, you need to check the status, that is, the independence and objectivity of the internal department within the entity. How independent and objective are they? Is the department just existing as a rubber stamp that is just for formality's sake? or is actually delivering on its core values. For instance, the internal auditors report, the internal audit department, they had 10 recommendations for the year, but only one has been implemented. That shows that the internal audit department is not fully effective. That's what it means. Compared to when you have an internal department that has 10 recommendations for the year and 6 of them have been implemented. That's how to know. Secondly, the technical competence and the operational care of the internal auditors. You need to look at who are those at the leadership, who are the audit staff, who are the internal auditors in the organization. For instance, the head of the internal audit read religious studies or zoology. He has not gone ahead to do any professional courses on finance or financial reporting or accounting. He has MSc in zoology and is the head of internal audit. That is an anomaly. Okay, or you have some of the internal auditors, they have a degree in microbiology. Okay, then you need to look at the nature and scope. You need to look at the nature and scope of specific work performed by internal audit. Look at the work that they do. Look at the audit report. See that the audit report has what we call substance. Okay, has substance that you can rely on, that you can utilize in your own in the external auditors engagement. Okay, so you need to be sure that they also have the necessary proficiency, okay, technical training to execute the work that they have been assigned to do. All right. So while looking at the audit report, you're looking at the work was properly supervised, because I know they are going to request for the audit report. For instance, when the auditors come to an organization that has audit department, after the opening meeting, the next one they are going to walk through or they are going to discuss with is the internal department. They will request for what? The auditor's report, internal auditor's report. That will form the basis of that will throw more light on how certain activities or certain report or engagement has been performed within the organization. You will look for whether they have sufficient and appropriate audit evidence. They will look at how they arrive at the conclusions, and if there are exceptions on matters and how those matters were resolved. You need to look at it. Sometimes you need to examine items already examined by internal auditors, just for them to be double sure with performance, okay? Sometimes they will need to examine other similar items, okay? And sometimes they will need to observe procedures performed by the internal auditors. Sometimes that will lead to areas of stock count, where they will just serve as an observer during stock count. All right? So the external auditors' role is to ensure that it can place reliance on the work of the internal auditors. But where it is not possible, right? The external auditors will do what? We set aside the internal auditors as though they never existed within the organization and continue with their external audit as though there had never been internal department within the organization. All right? So that is that about that standard, ISA 610, placing reliance on the work of the internal auditors. Okay? Any question? Comments? Observation? Any contribution? Yeah, good to go. Okay, let's go on. Let's go at the next area, the audit of accounting estimate. Right? The audit of accounting estimate, right, is similar to what you have in your CR IS 8. That talks about accounting estimate, prior year adjustment. Okay? Accounting and prior year adjustment, right? Is similar. But what we need to understand is that when you're talking about accounting estimate or an estimate, what does it mean? An estimate is an approximation of a monetary amount in the absence of precise means of measurement. Accruals, repayment, and inflation are examples of areas where estimates are widely used. Okay? What does it mean? So you have sales figure or revenue out of 12 months, you have for 11 months. You have January to November. You don't have December. But with the provision of January to November, you can estimate what December sales revenue will be at the end of the year because of the information you have from January to November. There would have been in a pattern, right? Now, what we are saying is this, as an auditor, is there's no gainsaying. That is, in every financial statement, you always find estimate. They make use of estimate. Because organizations, they prepare what? Budget. And budget are based on what? Estimate and what? Assumptions. Estimates and what? Assumptions. So what you need to do as an auditor is to check that those assumptions, they are what? They are reasonable. As well as what? The estimates. You have to be sure that what? They are what? Reasonable. And they are what? They are what? The estimates are what? Are also reasonable. Assumptions are reasonable. The estimates are what? Reasonable. All right? Then you need to also be able to ask questions on how they arrive at those assumptions. From there, you'll be able to know whether those assumptions are actually reasonable or they are not realistic. You're able to know from their what, from the discussions you have with the what, with the management. All right. So the auditor, in the course of trying uh, to analyze the accounting estimate, right? These are the procedures you will need to what to put in place. Number one, the auditor will need to know what are the requirements of the applicable financial reporting framework in respect to accounting estimates, including related disclosures. You have that one under IAS 8 that talks about parallel adjustment and accounting estimates, right? That's IAS 8. That is the financial reporting framework. Then how management identify transactions or events that could result in accounting estimate before, being recognized or disclosed. How did they arrive at it? You need to have that discussion with them to be able to know whether they have an understanding of what we mean by what accounting estimate. Then you need to look at the nature of the estimate. Is the estimate involve asset, liability, expense, or income? You need to be able to ask questions. Okay. The auditor should also review the procedures used by management to make their estimates, including the method used for estimating the useful life of a non-current asset. For instance, your client says that normally motor vehicles, they are 4 years. That is their estimated useful life. But your own organization, you say your motor vehicle is 3 years. You need to justify it. How do you justify that? You can say that, oh, in our own case, our cars, they travel wide area. They go miles. They travel across the state every day of the week. So if you have to use it for 4 years, the value of the car would have been overly depreciated. That's why we are using 3 years. And if it's justifiable by the auditor, it will approve it. It will consent to it. But when they cannot approve, when they cannot justify it, then you make the auditor to have doubt or try to qualify his audit opinion, because that means that certain information have not been provided to the auditor. And because that information has not been provided to the auditor can qualify his audit opinion based on what? Limitation of scope, absence of information, or absence of relevant information. Okay? That's what we mean by that. All right? So that's all about the area. Any question? All of this we have talked about them before. Any question, comment, observation? Question, comment, observation? Contribution? Are we good to go? Anyone should answer, please.
Good to go, sir.
All right, thank you. The last area for this chapter is, I just want to be sure that is the last. Okay, the last area of this chapter is this one, audit of specific areas of financial statement. Now, what this one entails is that you look at the financial statement, right? You look at the financial statement, and look at all those financial reporting standards, okay, that are used to prepare the financial statement and see how those standards, yes, someone is asking a question. Yeah? There's no ISA, there's no ISA, ISA 2. I is IAS 8. IAS, International Accounting Standard 8. Okay? You cannot use it to answer all these questions. Why I'm using it here is that I'm using it to draw reference. That is, if you understand IAS 8, that is National Accounting Standard number 8, right? It will aid your understanding of ISA 540 that talks about the audit of accounting estimates. That's what I said. Okay, I'm just using it to draw reference. There's no you're going to talk about audit. There's no talk about financial reporting or corporate reporting. There's no how. In fact, there's no you're going to talk about advanced audit and assurance that you not talk about all the other 14 papers that you have in your ICAN syllabus. There's no how. You can see that I've been doing that over time. Anytime I try to make analysis or try to explain some aspect, there's no how. So for you to be a facilitator in AAA, you must have an understanding of all the other 14 papers of the ICAN syllabus. Okay? Okay. I hope I've answered your question, Minister of Finance. Minister of Finance, I hope I've answered your question. Okay, thank you. So I was talking about this aspect, the audit of financial statements. So, like I said, this area is an area that we look at, you talk about how the financial reporting standards, okay, how they are being applied in the audit of financial statement, because there's why you're going to prepare financial statement, you're not going to use the financial reporting standards. So the auditor's responsibility here is to look at those financial reporting standards and see how they have been applied in that particular engagement. Do you understand what I'm saying? So for instance, IAS 1, you know that IAS 1 has been replaced from 2027, has been replaced with IFRS 18. They bear the same name. Presentation of financial statement is the same name, right? But from 2027, you will not have IAS 1 again. You'll be having IFRS 18. Now, what do we mean? For this exam, they are using IAS 1. Your IAS 1 contains auditing, accounting principles and accounting conventions. Principles, your cash basis, are you preparing your financial statement using cash basis, or you are using accurate basis? Okay, either you use cash basis or accurate basis, right? That is what we mean by accounting principle. Accounting conventions could be instances of what? Consistency. How consistent have they been applying the accounting principles? For instance, the utilization for the last 2 years, you have used, for your non-credit, you have used sum of digits method. But this year, you did not use sum of digits method, you're now using a reducing balancing method. That means the consistency convention or principle has been what? Has been compromised. What we are saying here is that the auditor will check whether you have consistently applied those accounting principles. I hope you understand what I'm saying. So that's what I mean by that. So for those that have done CR, those that are doing CR, what you need to do is just to look at those standards. You also have them in your look at those standards and see how the management have applied those standards while preparing the financial statements. Okay, so that is that about. So the essence is to use for you to test the compliance, okay, of those standards during the preparation of the financial statements. Okay, so with that, we draw the curtain on chapter 8, audit evidence. Any question, any comment, any observation? Question, comment, observation?